Welcome back, passive income investors. I like to the juiciest, dripping dividend stocks the internet completely has to offer. One of these is the most recommended dividend stock in the community. The other two are some of my favorites that are little holes in the wall in the internet community, and I don't know why people aren't talking about them, which is why I'm going to shine a light today, because there is some updated, most recent news, folks. So in the clarity of my transparency, hit that like button, because we're going to zoom out and kick it off by showing you I put my money where my mouth is, and we're going to talk about the number one most recommended dividend stock, obviously being Johnson & Johnson. Yeah, I know it's not exciting here, guys, but I love this company. I currently own 85 shares. I am up 13.7%. And yeah, there's a lot going on here, folks, because just taking a look at the chart, it's trading at a 29 PE. A lot of people think this thing is crazy overvalued, but I honestly think, and I'm going to show you why, I actually think it's discounted against Pfizer, Merck & Company, and many of these other healthcare stocks. In fact, this is the only healthcare stock I'm willing to own, and you're going to see why when I break this down. But being a dividend investor, this is the number one reason we hold any of these companies. And obviously, being the highest recommended dividend stock in the community, that always comes down to the fact that it's been paying and increasing its dividend for over 50 years here, folks. And I'm going to give you a little cherry on top of an announcement cake, because this company coming up is going to be releasing earnings Tuesday, April 20th. And because it hasn't increased its dividend yet, something tells me here, folks, unless I miss something, that we're going to get a dividend increase on the release. So keep an eye out for that. If you are a shareholder, should keep seeing that pie slowly increase. But more particularly, guys, why I like this over every other healthcare stock. And it's not going to be for the reasons you think. Because if we take a look at their segments of income, this is like an ETF of healthcare. They have pharmaceuticals, medical devices, and consumer health products. Their pharmaceutical sales from Q4 of 2019 to Q4 of 2020 were down just by under 1%, maybe about 0.9%. Now, medical devices was down rapidly because obviously the delay of people getting surgeries done. So going from Q4 of 2019, when they were doing 25.5% of sales in medical devices, to 16.5%, that is an insanely large decline year over year. And the only place they saw an increase in sales was in their consumer health products, guys, because it would be their Tylenol, their bandages, things that people would be loading up on, terrified of this pandemic. And we can see they've increased from 18.2% to 22.5%. But yet for some reason, when we scroll on over into their earnings here, folks, in 2019, they went from 82.05 billion in revenue, of total revenue, to 82.58 in 2020. How in the midst of a pandemic, when there's no surgeries and some of your largest sales segments have dropped a lot, yet you're still hitting record revenue? I mean, look at their actual gross profit margins, guys. Now, this is where they saw the decline, because obviously the cost of things going on, but I don't know how you sell more product than ever and make record revenues, but your gross profit is slightly down. So when you look at the EPS, you might be missing the fact that this company is still growing. Now, imagine we get on the other side of this pandemic here, folks, and all of a sudden surgeries bump back up, and all of these other things that they're involved with actually go back to a normality. If they hit record revenues in 2020, something tells me they're going to blow gangbuster earnings the second we head back to somewhat of a normal society here, folks. I mean, just take a look at the stability. We're not talking about massive growth, nothing crazy to Mars like Elon Musk would like, or people would like it to be like, if that made any sense. But still, we're buying this for stability and growth, folks. And the reason I chose this over all these other healthcare companies is there's not many that can actually say that they have stability behind their numbers. I mean, look at Bristol Myers Squibb here, big healthcare company. From 2019 to 2020, their revenues almost doubled. You think this would be one of the most amazing healthcare stocks to own, yet people don't realize the only reason that they had this massive increase is going to lead to a massive decline, and that's because the company's largest drug, Revlimid, and I'm not sure what that is, which garnered $12 billion in 2020 sales, will lose its market exclusivity, hard word to say, next year here, folks. So when one of your largest drug segments is about to fall off a cliff because the patent runs out, this is why we see, when we look at something like a Bristol Myers 5-year chart, or even the long-term chart, guys, it's very rocky. Most drug segments and most drug companies go through periods of insane volatility off their drugs, and it's hard finding drug companies that have somewhat stability. I mean, even Pfizer can't offer the same stability Johnson & Johnson does. From 2019, 51 billion in revenue to 41 billion in 2020. And I mean, just look at from 2017, they have roughly seen a continued downturn in revenue prices. What about Merck & Company, one that Buffett has been picking up? This one, however, a little more stable overall across the entire business. So I have to give them some credit on this aspect of it. I haven't done a deep dive analysis, but if I had to pick between the two right now, J&J and Merck are probably at the top of my list here, guys, just because of the pure revenue stability. But again, when you look at the stock, it doesn't look that stable, guys. Even comparing it to Johnson & Johnson, I mean, it's hard to find companies that can show such stable incline and stable revenue growth, even in the worst of times, and still increase their dividend for that matter. But yeah, that's Johnson & Johnson, guys. And even though, you know, a lot of people are like, oh my God, they stopped handing out the vaccine. Well, Johnson & Johnson was giving the vaccine away free for anyways, and 6 women had blood clot signs for some reason out of the 7 million doses they distributed. You know, 7 million people get the pandemic, the CV virus, that more of them get blood clots. But I think because, you know, we can't have anybody dying from these injections because it'll scare other people from getting them, that they have such a high standard of how these things are supposed to work on a health level. So, I mean, I got to give them credit. You got to give this entire marvel of distributing these drugs credit, guys. Can you imagine distributing hundreds of millions and billions of vaccines? I mean, these warehouses and the way they put this stuff together must be at a level that is so unimaginable. But putting that aside, let's talk about numero dos, Northland Power, a Canadian globally diversified energy utility company. I currently own 506 shares. That's a lot considering they're worth $22,107, up 86%, and actually the first stock I ever bought. I always rebuttal to every investor out there that loves dividends, find me a better monthly paying dividend stock that has grown as much as this and has offered like the crazy stability that it has, because I don't think it really exists, if I'm being honest. Now, Northland Power has run into all-time highs, and there's been a lot of confusion recently because literally in the last day, the stock fell off a cliff, and I have an answer to why it dropped 6%. And the PE sits around 25, so people are a little on edge with this because most people hear about like all the different solar companies and the Tesla companies and anything else, but no one ever knows about this little tiny hole in a wall called Northland Power. But I promise you, if you take 2 seconds to dive into their books, your mind will be blown by how fast this energy utility company has been growing, considering in 2019 they went from 1.6 billion in sales to 2020 where they did 2 billion. And another reason that I like them, they're Canadian, and the fact that their numbers are a little bit more smaller. I like being in the $1 billion range because it's high enough that the company has a proven product and business model, but it's low enough that the company can expand at a rapid rate compared to something like a Johnson & Johnson. It's easier to double your numbers when they're in the billions. Not so easy when you get into the hundreds of billions, right? And I mean, just take a look at the steady incline. I mean, this company has been proving year-over-year growth for the last several years. And taking a look at the dividend, sadly, no dividend increases. I managed to pick this sucker up, capping in over 5% yield. And the last time they did a dividend increase, I think, was back in 2018 when they went from 9 cents to 10 cents. I do not foresee anywhere in the near future them increasing the dividend any farther for the time being, which sucks. But that's because they become more of a growth company than a dividend company, in my humble opinion. Now, what most people are unaware of is that this company is the largest offshore wind producing company in the entire world. They have projects that are coming online in the next 5 years, all the way from Taiwan. They are going to be introducing New York to a bunch of on-land wind turbines. I mean, if I can just find a little sheet here, maybe I can show you guys the intensity of what they're involved with. So offshore wind is their majors. Germany, North Sea, a big project for them. Taiwan, Canada, the US, they're doing stuff in Mexico. They just did a purchase of something in Spain we're going to talk about. But offshore wind, a big one. They do onshore wind renewables, so that would be the solar wind combo, things they're doing in New York right now. Utilities, so obviously utility distribution, basically efficient natural gas. They're trying to reduce the exposure to this, but it's not one of their largest segments. It's just a nice little diversified piece of their pie. They're getting into energy and battery storage, and then they're doing renewable green fuels, so hydrogen and things of that nature. I really love this company because it's a pure play in the renewable. Most people don't even know the oil conglomerates like BP, Dutch Shell. They're all getting involved in renewables as well, but people just aren't aware of it. So I really like these pure plays because they're kind of getting the benefit from the Biden stuff, and they're still expanding with a lot of new contracts, including this one, where they basically just did a huge purchase to enter in the Spanish renewables market through an acquisition of 540 million watts operating megawatts, basically operating wind and solar power on a congruent 900 million equity financing. Like, this is the power generation for hundreds of thousands of homes. It's honestly honestly staggering, guys. And we can actually see it's nice because they show the 2021 adjusted EBITDA after the purchase. And after the purchase, their offshore wind projects now make up 57% of the total company's power production. Onshore makes 16%, efficient natural gas 19%, and then utilities in general 8%. So it's a very well diversified, highly leveraged in the offshore wind projects, which I attest is probably the best place to be because that's where there's endless wind, endless power generation, and it's much better than onshore wind and solar because obviously there's not always wind, there's not always sunshine, but in the ocean there's almost always wind. So it's an interesting take, and we can see that quality of their purchase and how it's distributed all across Spain here. Getting this foothold now when we know governments are doing these massive transitions and having the kind of foothold in all these other governments' pockets that Northland has, we know that we're just going to see a beautiful several years, if not decades, of continued revenue growth and continued benefits to the dividend community because this pays a monthly dividend, which is why I believe it is the best monthly paying dividend stock of all time. Leading into 3 here, folks, my third and last final dividend stock I want to talk about today. And this one also a monthly paying dividend stock, arguably a much better one if you want a higher starting yield. And this is a REIT, so it's taxed a little bit differently, obviously, than maybe a regular dividend paying stock like Johnson & Johnson. But nonetheless, this is an industrial REIT and a logistics center REIT. I currently own 278 shares. I'm up 14%, which is incredible because I literally only started purchasing this as early as this year. This one just hit all-time highs and continues to seemingly day after day for the time being, pumping out a 4.06% yield, a 27 PE. Now, you are not getting a discount, in my opinion, on this company, but if you kind of continued the growth moving forward, in the next few years, it'll be trading at a much higher discount, making it worth the premium for buying it today, in my humble opinion, which is why I picked it up. But just taking a look here, folks, they increased the dividend year over year. They've not ceased to continue doing this. And we're not talking about heavy dividend increases, but enough that it is suitable over the long term for the growth that you're getting behind on the equity side of it as well. And taking a look, guys, for a logistics REIT, which I'm going to explain to the beauty aspects of this company in a second, the beautiful aspects. But the total revenue for 2019 was $405 million. Going into 2020, it was $483 million, an increase of over almost 20% growth on the bottom line here for the revenue, which is insane for a REIT. It is in the middle of a pandemic when people are so worried about malls and all these small cap office REITs. This company has exploded. The pandemic has done nothing but benefit this company, and I am going to explain to you why. As we can see, they look a lot like Northland Power's chart where we're seeing steady year-over-year growth. So what kind of business are they running? Well, they are literally doing the shipping, packaging, and distribution for companies of the likes of Tesla, Amazon, BMW, and pretty much every major company you could have ever imagined existed. But they're doing it in a way that is so utterly diversified and so utterly beautiful. Whoever's managing this company, I applaud you, baby, because you're making it rain. You're making it rain. And let me explain to you exactly why they be making it rain. Because this diversification is utterly insane. Their portfolio spans 60 plus markets. The largest market exposure is less than 8%. The portfolio includes exposure to 45 plus industries. Their largest tenant makes up no more than 4%. And less than a third leases expire through 2023. And just take a look. The largest tenant at 3.8% is Amazon on their top 10 list. And then we got logistics, Eastern Metal Supply, FedEx Corporation, American Tire Distribution, Penguin Random, DS Smith North America, Ford Motors, Costco Wholesale Corporation. I mean, the top 10 companies that make up 12% of their total income are all Fortune 500 companies. And again, they even operate for Tesla here too, guys, which is absolutely staggering. And not only that, this company unfortunately does share dilution to buy new deals. So this is a company, unlike using stored value or moving properties around, they literally keep diluting shareholders to do further product or property purchases, which I kind of semi agree with, because basically, yeah, it's going to dilute me as a shareholder, but it's going to give us more access to more income over the long term. And they recently just keep doing this year over year, guys, and it works for them. They just did another acquisition for $25 million in Sacramento, California. That was a $25.9 million deal. They did one in Minneapolis for $10.2 million, 80,000 square feet, 267,000 square feet for the first one. And then the property located in Omaha, NE, not sure, I'm not in the US, sorry, I don't know these states off the top of my head here, but that's $24.9 million purchase, 370,000 square feet. So, I mean, this one purchase that literally just happened March 3rd equates to over 600,000 square feet I mean, what are they getting for these rental prices? Like, it's crazy to see how fast this company is expanding here, folks. So when it comes to STAG Industrial, I don't think there are many other REITs that are going to experience an insane growth rate over the next 5 to 10 years unless they're very pocketed for very specific reasons. I only own one other REIT called RioCan, and I believe it's poised to experience the greatest boom that's ever going to happen to an economy. That's because Canada is expanding at one of the fastest rates, even outgrowing India. And I have a hard time picking REITs because, I mean, you want a REIT that's not only going to be stable, but does offer some kind of growth into the future. And so far, anything dealing with logistics has been incredible. Anything dealing with cloud computing has been incredible. Like, a lot of REITs out there, people have been chasing that deal with all the cloud storage, which I think is great. And then finally, unless there's a REIT in a market that is showing some kind of future growth based on population density and proving stability, but since this pandemic has taken place, in my opinion, is far and few in between. So I only own 2 REITs, and I think I wanted to share STAG today just for the raw reason they're still making massive deals throughout all of this. They still hit all-time high revenues during the pandemic. And if you want a stable growing dividend from a REIT, I think we're going to see some incredible performance over the next 5 to 10 years. So in light of all this, folks, these are my top 3 REITs I just wanted to touch base on today, and I'll probably do this more. I want to do more top videos if this is something you guys enjoy for my growth stocks, and even other dividend stocks that I find interesting that I myself might not own. And heck, I even need to do the top 5 stocks that crashed that I own, because that would be a fun video in and of itself. But let me know what you guys think in that comment section below. And in light of all this, stay cool, stay awesome, and I look forward to catching you tomorrow.